Welcome to Global Entrepreneurship Week here in Kansas City. Happy you could join this morning. Nice to see so many people that are interested in starting their own business, and particularly during the pandemic. A couple of housekeeping items, as you probably can tell, everyone is muted. That's obviously to try to minimize distractions. If you have questions during the presentation, use the chat box. I'll try to check that during the presentation. And certainly if we have time at the end, I'll just open it up and see if we have other questions that I can answer. And with that, I'd say let's go ahead and get started. We're a little after 10. We've got a nice group here. So like I say, we may have others join us as time goes on. Everybody has attorneys, or if you're in business, you have an attorney and they tell you to make certain disclaimers. So certainly we're not giving ERISA tax, investment, legal advice. Presentations are provided for informational purposes only. And you should consult with and rely solely upon your own independent advisors. We're going to be talking about 401k plans. We're going to be talking about distributions and investing in your own business. So that's why this applies. Using pre-tax retirement funds to start or buy a business, commonly called a ROBS plan, ROBS, the acronym, stands for Rollover for Business Startup. It is a concept that's been around for many years, but yet most people have never heard of it. If you ask them about the idea of using their 401k, they'll look at you with a blank stare and have never heard of it, and that's normal. I've talked to angel investors, I've talked to bankers, I've talked to investors. So even those people who are into funding businesses have not heard of this. But I've got clients that have started their business, as far back as 2004, which is when our company originally started. So it's been around, and it's not a loophole. It's actually codified law that allows you to do that, and I'll get into that a little bit with you here in a little bit. My name, Mickey Parker. I am a CPA licensed in Kansas. I've been licensed in Texas in the past. I've spent most of my career as a controller or CFO for successful entrepreneurs in the small business space. So kind of get the feeling what it takes to be successful in the small business world. I've been a ROBS provider since 2011, and this is something we can do nationwide. I have clients from coast to coast, and even a client in Hawaii that I hope to go visit sometime. So I'll find a business reason to go see him. I hope when we're all done, certainly the idea here is to just give you an introduction to this concept of using IRA, 401k type funds to start or buy your business. We're gonna answer some of the real common questions. Is this legal? What retirement funds are eligible? How does it work? How do I exit a business in which I've funded it with my retirement plan? And then there are some CARES Act opportunities that are available to you, and we'll talk about that. The CARES Act was something Congress passed as part of the pandemic earlier this year. So there's some really important opportunities that act gives this particular concept for you. We'll talk about that. If you're starting or buying a business, certainly some common and traditional sources of capital, bootstrapping, using your personal savings and investments to start your business. friends and family, home equity loans, bank financing, credit cards. We've heard the stories of people starting their business with credit cards, and then obviously bringing on partners. That might be a financial partner while you may be the operational partner. Non-traditional sources, angel investors, venture capital, grants, crowdfunding. And what's really kind of non-traditional, simply because people haven't heard about it, is using your own IRA or 401k. Now you can take a distribution from those. In some cases, you can take a loan from those, generally not an IRA, but if you have an existing 401k with an existing employer, it may have a loan option. And then the last one is what I call the Rob's plan, bootstrapping with a K. So we're going to bootstrap with your 401k or IRA. If you take a distribution from your retirement plan, you're going to pay federal income tax at your normal rate. You're going to pay state income tax, and if you're under 59 and a half, the government imposes a 10% early withdrawal penalty. So I use the example, someone wanting to start a business with, and they need $150,000, and they say, okay, I'm going to take $150,000 distribution out of my IRA or 401k. Once they pay, and I use some estimates here, 24% federal, 6% state. Once they pay 30% of that in taxes and another 10% distribution penalty, they've actually netted down to $90,000. So when they thought they needed $150,000 for their business, now they only have 90 when they take a distribution and pay the taxes and penalties. So when you do the math on it, they actually have to take a $250,000 distribution to net to that $100,000 that they need to start their business. So it can the tax and the penalty becomes pretty substantial there, and we can avoid that with a Rob's plan. Now you can also take a loan if your current 401k plan allows it. Those generally have to be repaid in 5 years. You have to make quarterly or substantially equal payments. So if you went and said, okay, I'm going to start this business with $150,000, I'm going to take a loan, you're going to have to pay back about $34,000 a year in payments. So the downside to the loan is you're starting out in debt, and you're going to have to use some cash flow from your business to pay back that principal and interest. And that's principal and interest that you could use to grow your business. So that's another option where if you choose and it works out for you that a Rob's plan can work, a Rob's plan is an equity investment, not a loan. So you won't have to worry about making payments back. So what is a Rob's plan? It is, a method to invest funds from your retirement account on a pre-tax basis into your own business. You can do it without paying taxes or early withdrawal penalties. As I mentioned, it is an equity investment in your business. And here's what to give you an idea of the overall view of this, think about if you have a current 401k or have had one in the past. When you invest, you're generally investing in some mutual funds. Maybe it allows you to invest in some individual stocks. But what if that 401k plan allowed you not to invest in mutual funds or other stocks, but stock of your own company? What if your company stock was an investment option within the 401k? That's the concept behind a Rob's plan, is to allow you to invest those funds that are already in your account in the stock of your own business. Now here's what it's not. It's not a loan. And a number of people, when they look at it, say, okay, well, this is like a self-directed IRA. And it's not. There's some real significant differences between a ROBS plan and a self-directed IRA. First off, if you're going to start your own business, you want to manage it. You're going to run it. That's not available using a self-directed IRA. You're going to need to pay yourself a salary. This is going to be your business going forward. You can't do that in a self-directed IRA. You can do it. In fact, you're required to do it in a ROBS plan. And you also can own 100% of the business with a ROBS plan. Self-directed IRA has limits. Where we normally see self-directed IRAs being used is investors. Perhaps someone, maybe you've got somebody who wants to buy 10% of your business. They're not going to be involved in management. They're not going to take a salary. They're only going to own 10%. A self-directed IRA works for them. It doesn't work for any of the clients that I work with. So how does the process work? The first thing you have to do is set up a C corporation. And we'll talk a little bit about that in a little bit, about why it has to be a C corporation. That new company of yours is going to set up a retirement plan, a 401k profit sharing plan. That is a qualified plan. So you are allowed to transfer your existing retirement funds, whether that be a 401k, IRA, into this new retirement plan that your new company sets up. And what did we just talk about? What you're going to do is, rather than investing those funds in mutual funds, you're going to have your plan account buy stock in the new corporation that we just formed. So that's called qualifying employer securities. That's kind of the IRS term for stock in your own company. And that purchase has to be done at fair market value. So when that takes place, the funds are going to be transferred from your retirement plan to your corporate bank account. And in exchange, your retirement plan is going to receive a stock certificate. So your retirement plan owns stock in the company that you just set up and funded. Once you do that, you now have funded that company, and you can go start or buy a business with those funds. And that process takes about 2 to 3 weeks to complete. Quick question that came up: will these slides be available? I can certainly make them available to you, absolutely. I also have another PDF that I provide to other clients or prospective clients as well, and I can certainly provide that as well. Okay, first thing that comes up is using a C Corp. A lot of people know about LLCs, maybe S Corps. Why do we have to use a C Corp? And it's really, really simple. This is an IRS requirement. It's not a Mickey requirement just because you're doing business with me or working with me. The IRS says this is what's required. And the reason is that they define a qualifying employer security, which is what the code says you can invest in, as stock of an employer sponsoring the retirement plan. An LLC doesn't have stock. It has membership interests. So that's one of the reasons why it does not qualify. A little bit about C Corps, not going to get deep into tax issues, but in some cases the corporate tax rate is actually lower than personal tax rates, depending on the income level. So the most recent tax rates are 21% tax on a C Corp. Generally, fringe benefits are deductible at a C Corp. Sometimes that's not true to an LLC or S Corp. The concern usually that I hear when I mention C Corp is, oh, what about double taxation? Double taxation occurs because the C Corp has income and it's taxed, and then when the C Corp issues dividends to the owners, then those are also taxable. So you're paying tax on the same amount of income, tax twice on that income. That's generally not an issue for any of my clients. First off, number one, you get to pay and you're required to pay yourself a salary. You can hire employees, all that. You can make contributions to the retirement plan. But if you take advantage of all those things and you have a business that's generating enough cash that you're concerned about dividends, then what we recommend is that you actually begin a stock buyback. You start liquidating some of that stock that's in your retirement plan, putting the cash back. So double taxation is not really an issue with the ROBS plan. So I'm interested in this. How do I go about setting up a ROBS plan? You'll definitely want to use a ROBS provider. There's probably a handful of reputable ones around the country. There might be more than that. There's not a lot of them out there, and to my knowledge, I'm the only one generally in the Midwest that does this. But it's a nationwide, everything we do in setting up a ROBS plan is done by email, by fax, whatever. So like I say, I have clients nationwide, so it's not necessarily you can use a ROBS provider anywhere. Generally, the setup fees range from about $3,500 to $5,000 to set. That's to get you from where you are today to a fully funded corporation. I'm on the lower end. I'm in Kansas City. I don't have the overhead that some of the others do. Our firm charges on the low end of that. Most require an upfront payment fee. Not all do. We don't require an upfront payment to do that. You do have, when you set this up, you are setting up a retirement plan. So there's administration of that plan, and generally most providers charge $94 to $140 the last I saw. Again, we're on the lower end of that from our standpoint, but give you an idea of what it costs. And because of the cost of doing this, there are generally some minimums. We, as an example, because we have a lower fee, have a lower minimum. If you want to set up a business with $10,000 or $20,000, my feeling is that this is not the best a ROBS plan is probably not the best option for you. You probably ought to just pay the income tax and be done with it. But using the example before where somebody wanted to take $150,000, all of a sudden they've got $45,000 in tax. It now makes sense to pay $3,500 to set up this type of plan. It's a pretty significant savings. The other question I get is, do I have to use all the funds in my existing account? And the answer is no. If you've got $250,000 in an account and you only need $150, then you just roll over the $150 that you need into your new plan. That applies even if you've got $50,000 and all you need is $35. You can do that. Now, I also tell clients you can also roll the entire amount over, and your new plan will have an investment option in it. So, using my earlier example, if you roll $250,000 in, you could use $150,000 to go fund your business. Put the remaining $100,000 into an investment account that's in your new retirement plan. That's a nice way of keeping it all together in one place, and that's a lot of the reason people do that. Biggest question I get, is this legal? Can I really do this? And the general answer is yes, as long as you follow the rules. And that's why a ROBS provider is important. The ERISA Act of '74 is what established the rules that allowed private companies to establish their own retirement plans. And there are specific exemptions in that act and also in the IRS code that allows for employers' stock to be an investment option within a retirement plan. So it's with that exemption that allows us to move forward. In the IRS in 2008 also provided guidance, and we really use that 2008 memo from the IRS as kind of our Bible. It kind of tells us what they're looking for, what they felt like were abuses of the plan prior to 2008. So most ROBS providers look at that IRS memo as the guidance that they need to make sure that that the plan we establish for you is in fact compliant. A lot more detail here than you really want to know, but the idea here is that there are some specific, we certainly provide some of the statutory authorities that says that a profit sharing plan can purchase qualifying employer securities without being in violation of prohibited transaction rules. The code that defines a qualifying employer security as being the stock of an employer. So I won't go through each of these, but certainly is provided as some basis to the legality of being able to do this type of plan. Okay, what kind of retirement funds qualify? What funds can I roll over if I want to start a ROBS plan? Certainly a 401k, 403b primarily used for nonprofits. 457b is primarily state and local government officials have 457s. IRAs, profit sharing plans, money that you may have in a simple government employees who have put money in a thrift plan, that qualifies. Those are funds that can be rolled over into a ROBS plan. Specifically, two types of accounts that cannot be used. We are using pre-tax funds in a ROBS plan. So if you have money that you have allocated to a Roth account, which is a post-tax, you've already paid tax, it's just that the earnings is tax-free. Roth funds are not available to be used to roll over into a ROBS plan. IRAs that are inherited from a non-spouse. Your mother dies, you are the beneficiary of her IRA, that is not available to be used. Your rich uncle dies, leaves you his IRA, that's not available. If your spouse dies and you are the beneficiary of their IRA, that is in fact, you can do that. In fact, I have a client that I'm working with right now in the state of Washington where she's already had an existing business and she's starting a second business and using her spouse's once he passed, using his IRA to fund that new business. Very, very common question. What about the 401k of my current employer? Can I take funds from that? The answer generally is no. If you are currently employed, most plans allow you or require you to be terminated from your employment before you get access to those funds. Again, that's the plan document that your employer adopted. That's written in there, so you have to follow those documents. However, there are exceptions. So I always encourage clients, potential clients, to check with your HR department, check with the custodian. If it's Fidelity or Vanguard or Empower, whoever they might be using, the specific question you want to ask is, can I take any portion of my account and transfer it to another qualified plan while I'm working? While I'm working, that's the important part there. Now, what I have found is I've had clients come back and say, hey, yes, my plan does allow, but there are limitations. So maybe they can only take a flat dollar amount, maybe they can just take a percentage, but they are allowed a portion of it. But I will tell you that's unusual. Not most plans don't allow you to do that. And if they do, that's referred to as an in-service distribution, meaning you're still working, you're still providing services to that employer, so they're allowing a distribution while you're still working there. But unfortunately, that's not the case. Now, there's a little bit of good news here in that the CARES Act that was passed earlier this year by Congress does allow, and it allows plans to be modified and allow for early withdrawals, and they actually encouraged it so that you can take a withdrawal from an existing employer. They've set it up so that the first $100,000 that you take out or withdraw is penalty free. You do not have to pay that 10% early withdrawal penalty, even if you're under 59 and a half. Now that withdrawal has to take place by December 31st of this year. So something to think about if you are currently employed and want $50,000 or some portion of your current 401k plan, and you're thinking about starting a business, then think about that before December 31st, because the withdrawal to qualify under the CARES Act has to take place by December 31st. While you don't have to pay the 10% early withdrawal penalty, it is still a taxable distribution or a taxable withdrawal, but the CARES Act allows you to spread that income tax over 3 years. So for those that are using it for true hardships, being able to pay income tax over 3 years is a great deal. What's really important here and for Rob's plans is that withdrawals that you make prior to December 31st that get recontributed to a qualified plan within 3 years are excluded from income, so you don't have to pay the taxes on it. So what does that mean for you and for a Rob's plan? If you've experienced a COVID-19 hardship, and I actually put, if you can read it there, what's in the act with regard to what constitutes a hardship. If you've been diagnosed with COVID-19, but here's the far more broad part that applies to virtually everybody anymore. If you've experienced an adverse financial consequence due to being quarantined, furloughed, laid off, if you had work hours or pay reduced, unable to work due to lack of childcare, you also qualify for this hardship if your spouse or a member of your direct household has experienced any of those. So that's the hardship rule that allows you to withdraw funds from your current 401k and not have to pay the early withdrawal penalty and the spread out of the income tax. You can withdraw up to $100,000 by 12/31/20. You can withdraw more than $100,000. It's just that the first $100,000 is what is exempted from the 10% penalty. You turn around and put those funds into a Rob's plan, which is in fact a qualified plan. Remember here we talk about in the bottom that if you recontribute it to a qualified plan, the Rob's plan is a qualified plan, so that withdrawal that you took and you put it into the Rob's plan will be excluded from income, and there's no early withdrawal penalties. You can use that to start or buy a business. So a very short window here now to the end of the year that would allow you to do something like that if you're considering starting a business here before too long and would want to use existing funds, because normally your current employer's plan doesn't allow you to take that, but this in fact does. Let's see, question, what if you are not employed but do have a 401k? I'm assuming that would be a 401k plan from a previous employer, and yes, I mean that's available to you to roll over as long as none of it is invested in Roth funds. Then you can certainly use that to fund your Rob's plan. What type of business can I start or buy the answer is very, very broad here. Any type of business that provides goods or services. The exception that's specifically written in the rules is lending. So they don't want you to be a bank. They don't want you to pull the money out and just lend it to somebody else, a friend, a family member. Don't fund your ROBS plan and then lend your son or daughter money to start their business. That's not the intent here. Receivables financing, any type of a factoring business. So anything where you're lending money to others would be an exception that you don't want, or that's not allowed. What are some of the requirements? Again, we're going back to looking at that IRS memo that came out in 2008 that gave us some of the guidelines. The person who rolls the funds over must be a bona fide employee of the C Corp. That's normally given. Normally, if you're funding that business, you're likely to be the president and you're gonna be an active employee of that business. So I get the question, well, my dad or my uncle or somebody else wants to provide the funds for the business that I run. Now that's okay, as long as they have a bona fide role in the corporation. You have a dad or mom who has some accounting experience. Maybe you hire them to do the accounting for the business. But we're using their funds to roll over. They have to be an employee. Option number 2 is they have to receive compensation, W-2 compensation, not 1099. It has to be W-2 compensation. And so they have to be an employee. They have to receive compensation. That compensation for you, for the person rolling over the funds, must come from new revenues of the business. So what the IRS says is they don't want you to roll over funds into your corporation and immediately start paying yourself a salary before you start business operations. That would be considered a no-no. Now, you could pay other employees, because you may have to hire a few employees depending on the type of business you're in to get set up, get ready to go before you're generating revenue. So that bullet point there applies strictly to the person rolling the funds over. You cannot start paying yourself until the business starts generating revenue. Biggest issue here, and probably the biggest counsel that I have with regard to ROBS plans, is talking about prohibited transactions. There are certain things you cannot do, and it primarily deals with self-dealing. You can't do business with yourself or a related entity. Several examples that I've had. A person called and wants to buy an apartment building, but he wants to live in one of the apartments. That's a prohibited transaction. You can't do it. Wants to buy a fourplex, maybe in a college town, so that their son or daughter can live in one of them. They'll rent the other 3 out. That's a prohibited transaction. You can't do anything where you or a relative are part of the business transaction. I had a dentist call and say, I have a successful dentist practice. I want to use my ROBS plan to go buy a building, and my dentist practice is going to lease that building. Again, that's a related entity transaction. So that would not be allowed. So stay away from anything where you're doing business with yourself or a related entity. Another example that comes up, I had a gentleman who had a very successful manufacturing business. He wanted to use a ROBS plan to start a trucking company, because that's a big expense for a manufacturing, is getting it trucked off to clients. Because the primary revenue from the corporation that's funded by the ROBS plan was going to be from his manufacturing company, we couldn't do that. That would have been a prohibited transaction. The IRS would have come in and said, hey, this is prohibited. You're going to have to pay tax on the money that you rolled over. So that's why I say talk to your ROBS provider. tell them what it is you're looking to do, and let's talk about whether that is a prohibited transaction. Generally, if you're just, I have a lot of clients that go start franchises. That's clearly not, they're not doing business with themselves or any other related type of entity. So that works fine. Another question, I have an existing business. Can I use a ROBS plan to capitalize that, put additional money into it? And the answer is yes, but remember, it's got to be a C Corp when we do a ROBS plan. So if you have, I have a number of clients who had an LLC. So they talked to their CPA advisor. They either took the assets out of the LLC and put it in the C Corp, or maybe they contributed their membership interest in the LLC to the C Corp, and so that the operations of the C Corp was what was running the business. The C Corp now owned the business, and now you can capitalize that using a ROBS plan. But go back to this idea that it's got to be a C Corp. Now, when you have an existing business, there's an additional requirement. The IRS says that your ROBS plan cannot invest more than fair market value. They can't buy the stock for more than fair market value of that existing business. So that does require obtaining an appraisal from a qualified independent appraiser. Let's see what that existing business is worth. If it's worth $50 a share, then your ROBS plan will buy stock at $50 a share or no more than $50 a share in order to do that. So there's an additional step involved when capitalizing a current business. Let's see, question here. Can early withdrawals be made from a 401k of a previous employer without penalty? These funds would not be ROBS related. Early withdrawal from a 401k. So if it's still with that employer, and you have had a hardship, you should be able to withdraw those funds without the 10% early withdrawal penalty. Most funds have what, at least even the plan that we have has a COVID relief option. So if you make a withdrawal as a COVID relief option, then that will, both the 10% penalty would not apply, and it would allow you to pay the tax on that over a 3-year period. So what you use that for once you withdraw it is you can use it for business purposes. You can use it to pay personal expenses if you've had the COVID hardship. So the answer would be yes. You would not necessarily have to put it into a ROBS plan. The idea of the ROBS plan there is to keep you from having to pay taxes on it. You've got that. If you recontribute any money taken out under a COVID hardship back to a qualified plan, then you don't have to pay taxes on it. Let's see, does the ROBS provider also act as a tax preparer at the end of the year, or our providers? We'll get to that. Generally, the answer to that is no. In our case, we are not a tax preparer. You'll want to have a CPA that prepares, or a bookkeeper or an advisor who prepares your income taxes at the C Corp level. What your provider normally does provide is the retirement plan administration, and we'll talk about here. I think that's coming up here in just a minute. So let the CPA tax person do the income tax for your C Corp. Generally, your ROBS provider, like us, will do the retirement plan administration. And there is a tax form that needs to be filed. It's called a Form 5500 that all retirement plans have to file. And your ROBS provider, we do provide that and prepare that for you. Part of what your ROBS provider will do is the initial setup of the retirement plan. all eligible employees. You can't set up a plan that says, I only want me as the owner to participate or you as the owner to participate. All eligible employees must be allowed to participate. Generally, the plan options that are out there are profit sharing plans and 401k salary deferral plans. If you've had a 401k, you're familiar, that's where it allows you to take a portion of your salary and defer it, and then the company generally matches that. Here's what I was talking about, the ongoing administration. Generally, your ROBS provider will provide that support to help you maintain your retirement plan. Compliance testing, the 5500 is an annual, basically a tax return. You don't have to pay taxes, it's an information return. You generally have to supply individual benefit statements, a summary annual report to your employees, any of the distribution and 1099 processing. Your ROBS provider will do that as part of that. Early on, I mentioned the monthly fee being $94 to $140. And that range generally depends on what type of plan that you have. Exiting the ROB plans, you get down the road, you've had a successful business, or maybe not. The first option is, how do you get out of a ROBS plan? Unfortunately, some businesses fail. So the plan can be terminated due to insolvency. The business is not in business anymore. The stock is essentially worthless. So your retirement account has made an investment in a stock which is worthless. So you've lost money in your retirement plan, but that's not a taxable event. You don't then have to say, oh, I did something with my retirement plan. Do I now have to pay tax on it? You do not. It's just simply a bad investment inside of your retirement plan. On the other side, you've been successful. You're going to sell your company. Typically, that's an asset sale. The proceeds of that sale are going to go back to the company, back into the C Corp. So once the company is all cash, they've paid all their bills, then what we're going to do is take that money out of the retirement plan and move it out of the corporation, move it back into your retirement plan. So that cash is now in your plan in exchange for the stock. And then if we're going to shut the plan down and shut the company down, you end up transferring that out back to a traditional IRA at wherever you would want to do it. So that's generally what happens. I'm working on a couple of those right now where the client has sold their business, they've paid off all their bills, and we're transferring the cash out of the company, what's left. In some cases, it's a pretty significant number, sometimes in the millions, and we're transferring that back, and the increase, maybe they put $100,000 in and now all of a sudden they're putting $1 million. They put $100,000 originally in their 401k, put it into their ROBS plan, grew it, and now it's grown. Again, it's not taxable. One of the advantages, that's not taxable until you start taking it out as a distribution in your hopefully in the later years. Okay, quick summary, what we've gone through. ROBS can be a financing solution, allows you to use some funds you didn't think were available to you to use to help fund your own business with the ability of not having to pay tax on it and also not having to pay early distribution penalties. The CARES Act has that unique opportunity to use your current employer's 401k that's usually not available. That's something you'll have to work on or make a decision on by December 31st. That withdrawal has to come out by December 31st in order for that to work for you. And then, of course, as we talked about, there's specific guidelines and a reason why you would want to use a ROBS provider to get that set up. So